Alright, here is our strategy. This morning we got into, as you can see in this area, hopefully you can actually see this, we got into a BX call option. September, and the strike price $17. We got in at 73 cents. Right now it's sitting at 84 cents, giving us already a 10% gain. Anyway, so this is our strategy. Right now, here is our risk profile. At this point, at expiration, to break even, and this is on September 17th, to break even, we need BX to be above 1773. As you can see by this chart, which uses historical volatility and standard deviations, the probability of expiring above that point is only 35%. The odds not so much in our favor. But still, the option is a bargain. Actually, if you compare it to, and I'm sure you're familiar with this chart, if you compare it to the volatility, which is this bottom area down here that I'm just outlining with that square, if you compare it down there, the volatility is low, so the option was certainly underpriced, which means that once volatility returns to normal, the option price will go up even if the stock price doesn't move, which will give us a little leeway. I'm going to guess, let's see, we bought at 30% option volatility, and in the last 2 years, its normal range is just about, and we'll put a little more weight on recent times, its normal volatility is around 40%. So we can actually see how much of a margin of error we have by getting in at a good price. And in fact, we have over 30 cents, as you can see by this Theo price column. If the volatility goes back to normal and the stock price does not move at all, this option is worth $1.14. Right now it's worth 84 cents. We have 30% margin of error. And also because we got in at 73 cents, we actually have a 41 cent margin of error, which is good, very good. So at this point, these odds, they don't bother me that much. But just to control our own risk, first, we're going to place a money management stop, which that means it's not technically derived, it's just to conserve capital. If our option loses 50% of its value, we're going to get out of the trade with a loss. That means we bought at 73 cents. If the option declines down to 36 cents, we get out with a loss. But still, I'm at the point where, what is our strategy? We're going to hope that our good old BX right here, I'll go to the 6-month chart and get this a little more focused on the price series. And actually, we'll change the theme too. Just put in the comment boxes if you can, help me out. Is this more readable, or do you like the white one better? But this is what we're going to do. We're going to hope that BX does something like this in the next few months. We're hoping that it starts here and it goes that way, straight up. Or at least somewhat straight up. Because then after that, we're going to start using risk control. Our option, which we initially bought for 73 cents, as soon as the next strike price option, so let me make this clear, we bought the 17 calls at 73 cents. When the 18 calls are worth 73 cents, we're going to sell one of them. So, while our initial risk profile looks like this, giving us a break-even of 1773, and then unlimited gain from there, if we add that call option, if we sell it, and we sell it at 73 cents, assuming it gets there, our risk profile now looks like this. Take that back. I got to equal this out. There is our risk profile. And this is very, very favorable. We have, actually, watch. our break even. It does not exist. Why? Because we sold that option for the same value that we bought the 17 option, our maximum loss is 0. But if the stock goes above 17, we're making money. If the stock goes above 18, our maximum gain is then $100, which $100 on a 73-cent option, we've made over 100% gain. Excellent. So, game plan. Wait. Hopefully this goes up before it hits our stop level. As soon as the September 18 strike price option is worth 73 cents, the call option, as soon as it's worth 73 cents, we sell it. This trade has absolutely no risk of loss then, and we hang on to it until expiration and we profit. Sounds good? Sounds good to me. Actually, let's say we want to actually see what are our chances of profiting once we do that. It knocks it up to 45%, and we have a 55% of breaking even. I'll take those odds. We get 0 risk and some reward. Thanks for watching. If you have any comments, post in the comment section, please.